You own 100 shares of Apple. You bought them at $170. Apple is now trading at $182. You are sitting on a $12 gain per share, $1,200 of unrealized profit, and the stock is doing nothing. It has been flat for 3 weeks. Here is the question no one asks in that situation. Can you get paid while you wait? The answer is yes. The covered call is the strategy that generates income from shares you already own every single month without selling them. It is the most widely used option strategy in the world among long-term investors. It is not a speculation. It is not a hedge. It is a systematic way to extract cash flow from a position you are already holding. This video covers the complete setup, the real numbers, and every scenario from entry to exit. The covered call has 2 components. Component 1, you own 100 shares of the underlying stock. Component 2, you sell 1 call option against those shares. That is the entire structure. The word covered means your short call is covered by your stock position. If the buyer of the call exercises their right to buy your shares, you have the shares to deliver. You are not exposed to unlimited loss, unlike a naked call, which is one of the most dangerous positions in options trading. The premium you receive from selling the call is yours immediately. It lands in your account the moment the trade fills. From that point, one of 3 things will happen at expiry, and each scenario has a defined, predictable outcome. This strategy works because you are giving up some of the upside in your stock in exchange for guaranteed income right now. Before the numbers, understand why the premium exists. When you sell a call, you are selling someone else the right to buy your shares at a fixed price by a fixed date. That right has value because the stock might rise above the strike before expiry. The buyer pays you for that possibility. As the seller, you are being compensated for the risk that your shares get called away at a price below where the stock ends up. The key insight: you are selling time and uncertainty. Theta works in your favor as a seller. Every day that passes without the stock reaching the strike, the option loses value, and that lost value stays in your pocket. This is the opposite of being a buyer, where Theta is your enemy. As a covered call seller, time is your asset. The longer the stock stays below your strike, the more of the premium you keep. Strike selection for a covered call depends on your objective. 3 choices. First, out-of-the-money strike, above the current stock price. Expiry selection follows the same Theta logic as buying, but in reverse. As a seller, you want Theta to work as fast as possible. Theta decay accelerates in the final 30 days. This means the ideal expiry window for a covered call is 30 to 45 days out. You capture the accelerating decay curve without tying up your shares for too long. A 90-day expiry collects more premium in absolute terms, but Theta is slow in the early weeks. You are waiting a long time for decay that happens mostly at the end. A 7-day expiry has very fast Theta, but very low absolute premium. The income per trade is small. 30 to 45 days is the sweet spot. Meaningful premium, fast enough Theta, and a regular monthly rhythm that lets you run the strategy consistently. Most covered call traders target the standard monthly expiry, typically around 30 to 45 days out, and reset every cycle. Here is the real trade. Apple is at $182.50. You own 100 shares, cost basis $170, current value $18,250. You decide to sell the $187.50 call, 35 days to expiry, $5 out of the money, a 2.7% move away. The bid is $2.10. The ask is $2.30. Mid-price, $2.20. You sell 1 contract at the mid, $2.20 per share, collecting $220 immediately. That $220 is yours regardless of what happens next. Your effective sell price, if assigned at $187.50, $187.50 plus $220 premium equals $189.70 per share, a $19.70 cost basis exit if the trade runs perfectly. On the options chain, you locate the 35-day expiry and navigate to the call side. At the $187.50 strike, bid $2.10, ask $2.30, mid $2.20. Delta, 0.32. This delta tells you the approximate probability the option finishes in the money, roughly 32% chance of assignment at expiry. Stated differently, a 68% probability the option expires worthless and you keep the full premium. Implied volatility on this strike, 23%, close to the historical average. No spike, no compression. Volume, 840 contracts. Open interest, 2,160. Liquid, you can exit the position cleanly if you need to before expiry. The order, sell to open, 1 contract, limit at $2.20. Filled in under a minute. The profit and loss diagram for a covered call. The horizontal axis is Apple's price at expiry. The vertical axis is your profit or loss on the combined position, stock plus short call. Below the strike of 187.50, your P&L is your stock gain or loss plus the 220 premium. At Apple 182.50, flat, you are up $220 from the premium alone. At Apple 170, your cost basis, you break even on the stock but keep the 220, so you are actually 220 ahead. The maximum profit is capped at the strike plus premium, 187.50 minus your cost basis of 170, plus 220 premium, a gain of $2,190 if assigned. Above 187.50, you do not participate in further upside. That is the trade-off you made. The break-even on the downside, 170 minus 220 equals $167.80. The premium gives you a 220 cushion below your cost basis. Scenario 1. Apple stays below 187.50 at expiry. Apple finishes at 185, up $250 from your entry price. The call expires worthless. The buyer receives nothing. You keep the full $220 premium. Your shares are still in your account. You have lost nothing, given up nothing, and been paid $220 for 35 days of waiting. Your effective return for the month, $220 on $18,250 of stock, 1.2% in 35 days, or approximately 12.5% annualized from the premium alone, on top of any stock appreciation. This is the ideal outcome for a covered call trader. The option expired worthless. You keep the premium, and you can immediately sell the next month's call to repeat the process. This is the income machine. Collect, expire, repeat. Scenario 2. Apple rises above 187.50 at expiry. Apple finishes at 193. Your call is in the money. At expiry, your shares are called away at 187.50, the strike price. You sell 100 shares at 187.50, regardless of the market price. Your total proceeds, 100 shares at 187.50 equals $18,750, plus the $220 premium already received. Total $18,970. Your cost basis was $170 per share, $17,000. Total profit, $1,970, a gain of 11.6% on your original investment. The trade worked, you made money. The only sting, Apple went to 193. You left $5.50 per share on the table. That is the covered call trade-off, capped upside. You chose income over maximum participation. Both are valid. Know which one you want before entering. Scenario 3. Apple falls. Apple drops to 175 over the 35 days, a $750 decline from your entry. Your call expires worthless. You keep the 220 premium. But your stock has lost $750 per share, $750 on 100 shares. Net result, negative $750 plus 220 from premium, a loss of $530 on the combined position. Without the covered call, you would have lost $750 on the stock alone. The premium reduced your loss by $220, a 29% reduction in the damage. This is the downside cushion effect of the covered call. It does not protect you from a large move down. It is not a hedge. It is a partial buffer. For meaningful downside protection, a different strategy is needed. The covered call's job is income on a flat to rising stock, not insurance against a falling one. Managing the position before expiry. 3 situations where you act before the option expires. Situation 1. The stock rises sharply toward the strike with weeks remaining. Your short call has gained value, meaning it now costs more to buy back. You can buy it back to close the position and avoid assignment risk, or roll it up and out, buy back the current call, and sell a higher strike at a further expiry, collecting additional premium. Rolling extends your income stream and adjusts the cap higher. Situation 2. The stock falls sharply. The short call loses most of its value quickly, Theta plus Delta working together. At this point, the call might be worth 20 or 30 cents. You can buy it back for a small cost and close the trade, freeing up your position for a different strategy. Situation 3. You want to sell the shares. Let assignment happen at expiry. You get the strike price plus the premium, your planned exit price. When the covered call works, and when it does not. It works when you own shares with a neutral to mildly bullish outlook. You want monthly income without selling. The stock is near fair value, not in a sharp uptrend. Implied volatility is moderate to high. Higher for means more premium. It does not work well when the stock is in a strong uptrend. You cap your gains and underperform. The stock is falling sharply. Premium provides some cushion but does not stop the loss. You are not comfortable with assignment. If you want to hold the shares at any price, do not sell calls against them. Implied volatility is very low. Premium collected is minimal, not worth the cap on upside. The covered call is a yield enhancement strategy for long-term holders. It is not a trading strategy for volatile momentum stocks. Match the tool to the market condition. This is what separates consistent income generation from frustration. The complete covered call on one page. Stock position: 100 shares of Apple at $170 cost basis. Current price: $182.50. Call sold: $187.50 strike, 35 DTE at $2.20. Premium collected: $220. Received immediately. Delta at entry: 0.32. 68% probability of expiring worthless. Maximum profit: $1,970 if assigned at the strike. Break-even on downside: $167.80. The premium provides $220 of cushion. Scenario 1. Stock below strike. Keep $220, sell again next month. Scenario 2. Stock above strike. Assigned at $187.50. Total exit price $189.70 with premium. Scenario 3. Stock falls. $220 cushion reduces loss. Monthly income target: 1 to 2% of stock value per cycle, depending on for and strike selection. This strategy repeats every 30 to 45 days for as long as you hold the shares. Here is what you now know and can now do. 1. The covered call generates immediate income from shares you already own by selling someone else the right to buy them at a fixed price. 2. The premium is yours the moment the trade fills, regardless of what happens at expiry. 3. Strike selection determines the trade-off between income and upside participation. Out of the money gives more room. At the money gives more premium. 4. 30 to 45 days to expiry is the sweet spot. Theta accelerates in your favor and you reset monthly. 5. 3 expiry scenarios, all predictable. Stock below strike, you keep premium and repeat. Stock above strike, shares called away at a profitable price. Stock falls, premium reduces the loss. 6. The covered call is a yield enhancement strategy, ideal for flat to rising stocks, not for volatile momentum names or sharp downtrends. That is video 8 complete. The next video covers the cash-secured put, the other side of the same income generation framework, and the strategy that lets you get paid to buy stocks you want to own.